Hey everybody, Ben Hart here. It's June 9th, 2023, weekly roundup. Listen, Scott and I just recorded a weekly roundup. I had some technical difficulties. My computer was shutting down and had to dial in from my phone, and so we didn't get recorded, unfortunately. So I'm going to give you a quick update just on what happened last week. Run through the charts. I wasn't able to do that in the call because it was on my phone. So I'll take you through some of the info from this week and what I saw. We had a good couple of days in Montreal this week. I'm going to share the screen, just talk to you a little bit about. We had our National Business Conference. It was in Montreal. We had about 700 attendees, advisors from across the country. Had some good chance to share some ideas, what's working for people, what's not. But we also had an amazing lineup. And so when Scott and I came over here from Wood Gundy to National Bank Financial, part of the interest at the time was just, they're really thinking about what's coming ahead and what how the business is evolving, how they can help us with their estate planning teams and financial planning teams and technology, and really thinking about what's going on in the world. And so, we're fortunate to spend a couple of days with some very interesting people. So I thought I'd highlight a few of the speakers that we saw, just to give you some context around who was there and what it was like, and just give you a sense of what the bank's doing, as well as what National Bank Financial is doing. So we had a whole litany of speakers, but highlighting a few of them here. So this was our first speaker. He's the ex-CFO of Google. Very interesting guy. He spent about 10 years supporting Google, 7 years in the CFO role, and 3 years in an advisory role. He was chairman of the board for Twitter when Elon Musk purchased Twitter. So we learned a little bit about that. But my real takeaway from him is he grew up in the technology space. His view is we've gone through kind of decades of evolution. He thinks we're on the fifth cycle of this technology evolution, and the fifth cycle, in his view, was AI and AI related investments. And so, very interesting. Get his take on the world. He works. He's on the board of Lightspeed. Has some investments with Zwift, and so just really interesting to think about what he's doing and just the space they're in there. In addition to that, we had a couple of interesting speakers. So Morgan Hansel spoke, Psychology of Money, real interesting view just about how money works and psychology. And, he started writing this book in 2008 as we were going through the financial crisis. And so, he gave us an interesting take on the world, which I thought was worthwhile. Good book, interesting. Scott and I both read it. It's interesting just to kind of think about how money and people react to the different scenarios. The second book there, Common Sense, The Wealth of Common Sense. This is Ben Carlson. He's got a good podcast and an interesting blog. Talks about just what's happening in the investment world. Interesting guy for sure. Couple more of the external partners we brought into this is we had Jean-Francois Menard, who's a sports psychologist. One of the people he coaches is Mikael Kinsbury, one of the most decorated Canadian Olympic winter athletes. And so interesting to see their take around kind of decision making and process, and in there to really kind of help us think through our days and think through how we're communicating with you. And so that was quite a good session as well. And then from an internal perspective, we had Martin Leflaive, who is our Chief Investment Officer, brought some interesting views around where he thinks we are in the cycle. Quite sharp. He debated with a couple of other chief investment officers, and Martin really did a great job. So very interested with him. This was our chief economist, Stéphane Marian. Stéphane gave a really nice update on where he thinks we are in the cycle. He was quite humble in his views. He thought that he was surprised by the rate increase that happened, really said driven by the housing market and the fact that immigration continues to be red hot, and said effectively, the most houses we've ever built in a year in Canada is something in the neighborhood of 246,000, yet we're north of 500,000 new people coming to Canada each year. We just don't have the capacity to keep up with this. And so you got house price inflation, but then you have the other areas of inflation falling. So interesting to hear his take on it. You know, he thinks Canada is quite different than the US because the US doesn't have those same types of issues. Plus, they have a different mortgage system down there, which is based on the 30-year bond market, not as susceptible to short-term rate increases. So interesting view, thinks that the two countries and economies are moving in different directions at this time. And then, of course, our last was Laurent, who is our CEO. And so Laurent took over about a year and a half ago. And he gave his take on what's happening, really kind of how National Bank's positioned. And, you know, we're in a position of strength right now. They've been defensively positioned, so they have some cash. They're in a strong place. You know, they really are a big supporter of National Bank Financial. Kind of the two areas that they said they want to focus on for growth in Canada is National Bank Financial, which is us. What we do is servicing you, and the commercial banking side of the business. So nice to be a part of an institution that's looking to continue to support and put money into this business, and hopefully allow us to give better service and advice to you, and better technology there. So I thought that was worthwhile, just having a quick, give you a quick sense of what and how that looks right now. And so, of course, on Wednesday we had the surprise with rates going up. But I think if we looked, I think at this job number come out, it may have potentially played an impact, because that last piece of the pie that the central banks have been talking about is employment. And so we had this number come out today, which is we got an uptick in unemployment in Canada. And so this will be certainly something that we're going to pay very close attention to, this continue or not. Quick look on the kind of the top of this slide, and you'll see that most of the job losses came in Ontario, 24,000 job losses in Ontario. And the other thing that's obviously concerning is that the majority of job losses came in full-time jobs. And so as we think about the implications of this longer term, we certainly need to see what that impact will be. This is a great chart from Hedgeye talking about LEI, and this is effectively leading economic indicators, LEI. And so when we look at this from 1960, obviously this is a nice long kind of picture to give you a sense of what this means over kind of a longer term cycle. And just effectively what this says, every time we get to these kind of levels, quite depressed levels like we're seeing right now, it's been right about 100% of the time to forecast a recession. And so continue to watch this and see how this plays out. But this is why I say I think US and Canada are in slightly different positions at this given point. And if we want to look at forecasts, because I often and continue to get this question about where rates going. And so I talk, I think, quite frequently of the fact that the market is already starting to price in rate cuts. And, you know, obviously, even though we saw an increase there on Wednesday, the market's still pricing rates coming down. And so if we look at Canada, this is the Canadian data. I didn't put up the US one, but I could. Looks quite similar. So Canadian data, if you look at effectively a year out, you're talking about a 1% lower overnight rate. So, you know, we'll see if that happens, but that's currently what the market is pricing in. I thought it was worthwhile just to have a sense of what that means. Certainly on the 5s and 10-year rate, that's worth thinking about too if you own bonds. Obviously, if this number is going down, that means your bond prices are going up. So a couple more quick ones, and then I'll wrap it up. But as we look around the world, one thing that we've been talking about since last summer was this inversion, where the 2-year bond is higher than the 10-year. That inverted yield curve tends to signal a recession. And how long does it take until you get one? Depends. Historically, though, it's been in the range that we're in right now, effectively. And so if you look at Canada, as I mentioned briefly, you know, Canada's at kind of 113 right now. So that means the 2-year rate is 1.13% higher than the 10-year rate. And if we went back to a week ago, effectively, or a couple of weeks ago, you can see that it's a pretty material move after the rate increase. And then in the United States, we're 80 basis points. If you look at some of the other major countries around the world, Germany, United Kingdom, France, South Korea, Australia, Mexico, most of the major countries in the world are having that inverted yield curve. And so we'll continue to watch and pay attention to that. So the last one, just before I jump off and move on, continue to talk about housing because it plays a major role. So what's the impact in the economy is the question I get often, and say it's a big number. And it's probably somewhere between 8 to 10% of GDP just on a direct housing related number. I think secondary and tertiary GDP numbers, it's bigger than that. So, but if we look at Ottawa-Gatineau, you're looking at the price for a home in this market of about 700,000 for non-condo. You'd need about $167,000 in income to qualify for that. It takes you about 56 months of savings for it. One of these things that I think is interesting, it says premium for buying compared to the national urban composite. So Ottawa continues to be attractive relative to the rest of the country. And I'd say the last piece on it would be this one here in the bottom right corner, where it is now more expensive to own a home than it is to rent. And so as you see that crossover, that tends to have a material impact on for what happens to that renting versus buying scenario. And so, continue to watch this quite closely. And I think the two combination of things of immigration and interest rates are kind of fighting against each other. And I think we'll have to watch and see how this plays out. So thank you very, very much, everybody. We have a truncated version this week, but next week I'd be watching to see what's happening in the world. As always, I've started to post just kind of updates on some of the charts that we do, 15 to 20-second updates on LinkedIn, YouTube, or Facebook, just to give you a sense about kind of a little bit more context around what the charts mean and what they're for and how I think about it. And so, my view hasn't changed dramatically from the rates changing this week. I had some great conversations this week from different investors as well. But my view hasn't changed too much. Growth and inflation are slowing. Now that we've seen kind of these first couple of upticks in unemployment as well, we'll watch that closely and see what it does to the market. But I still think you want to have exposure to those bonds, high quality government bonds. I think that's the best opportunity here. And as we start to move through this, I think we're going to get an opportunity for some of the areas, maybe the commodities or fertilizers, things like that. Some of these companies have been beat up pretty bad. So I'd be looking to take advantage of that opportunity as it presents itself. And if you, as always, need anything, Renad's been booking meetings and reaching out to make sure we have all our paperwork up to date. If there's anything you need from us, as always, please give us a call, and look forward to seeing you next week. Thanks very much. Take care, everybody.